What is a stock option? It is an agreement or a contract. This contract is in between two different parties. It allows or permits the buyer an opportunity of buying or selling the shares or stocks that are underlying at a certain price that is predetermined and under a specific time period. Option writer. The option writer is the seller of the stock option. The seller is paid a premium from the contract that is bought by the buyer. Types of stock option. A stock call option. It offers the purchaser the right but not the responsibility to buy stock. A call option will grow in value when the underlying stock price increases. A stock put option. It presents the buyer the right to sell a stock short. A put option will decrease in value when the underlying stock price goes down. Investment bankers can buy both of these two types of options. They can buy it individually or together with each other to apply some trading techniques such as a covered call. What is the strike price? With stock options there comes a predetermined price, which is called a strike price. For instance, an investor's purchasing call AAPL contracts at the strike price of $105, despite the fact that the current market price is $107. As an alternative, they can purchase the call option at a strike price of $110. Now, an option strike price of $105 is known as in the money. The strike price $107 is out of the money. In the money options result in a profit when practiced, while out-of-the-money options will result in a loss when practiced. Settlement expiration dates. Each option comes with specific expiration date and rule for settlement. Option styles in the markets. An American-style option. It permits the holder of the option to exercise the call or put option whenever they want before the expiration. A European-style option. It only permits the option to be exercised on the expiration date when the holder of an option exercised his right in the past. The transaction was processed and the certificates of stocks were given to the holder. Employee stock options. Employee stock options do not trade on an exchange, but they do have some similarities to traded options. Key ideas. Grant date. It is the date on which employees are granted the options. Vesting schedule. It is the timetable in which the employees get full control over the options. This may vary by company. The options may also vest all at once or progressively over time. Only the vested portion is allowed for exercise. If one leaves the company, vesting will usually stop. The strike price. It is the price at which the shares can be purchased. The expiration date. It is the date till which the options should be exercised. If the options are not exercised by this mentioned date, they expire. Incentive stock options. These are more complicated in terms of their taxation. Employees can be liable for regular income taxes, long time period capital gains, the alternative minimum tax in diverse combinations. Let's see few things one has to do and consider. 1. Read the option agreement. You need to understand the whole thing contained within your options agreement. This is each compensation and an investment option. You must be sure that you are aware of the potential tax impact and also about what you need to do to exercise the options. You may consult a financial or tax professional for help purposes if needed. 2. Understanding options in your financial plan. Take under consideration how this option grant and the underlying shares get fit into your general financial plan and the investment strategy as well. When exercising, make sure to remember whether or not the shares will make you over-allotted to your company's stock. A focused position in any stock can be risky, especially in the case with your employer's stock. 3. Commit to an investing strategy. Strategy is important. You buying or selling the stock. You must know that the public companies have particular trading windows for when employees can purchase and sell the stock. You also have to do any tax planning around the options if appropriate. Some options to consider around exercising the options. A cashless exercise. It is where you exercise the options and sell the options almost quickly. The net profits from the sale are deposited in your brokerage account and one has the option to reinvest the money elsewhere. A cashless hold it is same in that you exercise the options and then sell enough shares in order to cover the costs and then you can hold the remaining shares for investment, letting the options expire. It is a really good strategy if the market price of the stock is lower than the strike price because it makes no economic sense to exercise and then sell at a loss. Conclusion. A stock option is basically a financial instrument which allows the option holder the right to buy or sell shares of any certain stock at a specific price for a specific period of time. As investing in stocks do carry a certain level of risk, a stock option is risky investments. That's it for today. I hope you learned something about stock option. Leave a comment below. Please like and subscribe for more videos.